Hello everyone and welcome to another real estate video. This is Javier Vidana, the real estate YouTube guy here in Phoenix, Arizona, helping you accomplish your home goals. If you don't know where I am, I'm actually in my home office today, which some of you guys might recognize from my early pandemic videos, right? Because we're in quarantine, but I want to make this video today here because I want to show you guys how to determine if the loan that you're being quoted is a good loan or not good loan, or in other words, how to compare different loans. Because one thing I always get is, people will email me or they'll DM me and they'll like send me the entire scenario of their loan. Like, this loan is gonna give this interest rate, here's the loan amount, blah, 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 blah. Which is the best one. And I love when you guys reach out to me, but I'm not going to take like 3 hours to stop everything I'm doing to look deep into your loan program to give you the best idea, right? So what I'm gonna do is kind of like the whole teach a man how to fish. That old adage, give a man a fish, feed him for a day, teach a man to fish, feed him for a lifetime. Yes, I did have to Google it because I didn't remember it. That's what I want to do today. I want to teach you guys how to compare your own loans and figure out which is truly a better deal long term. I'm doing this because I'm going to do this interesting thing where I'm going to be on the screen at the same time. So if you're noticing the difference of quality, that's why. So I apologize. And by the way, this is actually my streaming setup. So if you ever checked out my lives, I go live on YouTube, I think 3 times a week, once on the weekend, twice during the weekdays. So if you ever see me live, go ahead and pop in, guys. It's actually a really good time, a good opportunity to ask me any questions you might have. I also go live on Twitch at the same time. Spit everywhere. So if you guys are on Twitch as well, you can, links are all below if you guys want to check that out. But anyways, let's get to it. When you talk to a lender, first thing they're going to ask you is, what kind of down payment do you have? What kind of situation are you in? Blah, blah, blah. They pull up your credit. Okay, then you qualify for this amount. And they give you a pre-qualification form that tells you how much you qualify for. And usually that's all they give you. So I need you guys to put on your big boy and big girl pants on when you pre-qualify for a lender, because if you don't take charge of your own situation, someone else is going to take charge of yours and take advantage of you. When you're comparing loans or pre-qualifications, don't just settle for the pre-qualification form. Ask them to send you like the closing cost sheet of what their fees are going to be. Now, a lot of times they're going to send you the entire closing cost estimate and like give you a big number like $5,000, $6,000, $7,000. This includes all of the closing costs that are being estimated. We don't want to know what their estimated cost of the title fees are going to be, the HOA fees, etc. We don't know what kind of house you're going to buy yet, so we don't have that information. So ask strictly just for the loan fees. What are you charging me to do my loan? Loan origination fees, appraisal fees. Second thing I want to make a quick note about is the interest rate. So listen, usually when people call around, they're trying to find the best interest rate, right? And they're trying their best to see who's going to give them the better deal. They'll talk to a lender and be like, what are you going to give me for an interest rate? Call lender, what are you going to give me for an interest rate? And usually that's the main focus because that's the easiest thing to focus on. But let me just challenge your thinking for a bit. No one can lock in your interest rate until you're in escrow. Every lender has a different philosophy of how they do things. One might be a little more desperate for your business. One might be a little, they're going to be conservative with their numbers because they got plenty of business. They don't mind if they lose you, and they would rather give you a high number. That way they can quote you lower down the road. It's important that you find out their philosophy when you're talking to them. So you're talking to lender A, and lender A says, we're going to give you this interest rate. And, before you get all wrapped up, say, okay, great. So are you quoting me low or are you quoting me high? What are you going to do if the loan, changes? Because honestly, guys, the market's changing on a daily basis. And if they're giving you what the lowest rate in the last 30 days was, then that's just 15, 20 days ago. That's not accurate to what is today. Or they might be giving you an idea of what the interest rate is today, but you might not find a house until 2 or 3 weeks from now. So find out their philosophy, if they're being aggressive or they're being conservative, and play it by ear. One thing you absolutely want to be sure as well, that kind of ties in with the first point, is make sure that the rate they're giving you, it's the actual rate without any discount points, because mortgage providers can actually do this thing called discount points, where there's a direct fee paid directly to the lender that reduces the interest rate. So a lot of times, especially the online banks, when you're shopping around loans online, you're going to notice that the interest rate's like super freaking low. And if you go down in the asterisk, it'll say, one or two mortgage points deducted or whatever, I don't know. So this is the rate they're giving you, but they're not disclosing that you're going to have to pay a little extra more cash to pay them to give them a better rate. But just to kind of conclude that interest point topic, don't have that be the entire focus. it's great to try to get a better rate, but you can't guarantee that rate until you're in escrow anyways. You know, if they're giving you a super freaking low rate, and you know, those might be the kind of lenders that once you're under contract, they're gonna go, you know what, the interest rate's actually gotten up, we're not gonna be able to honor that same interest rate we gave you. And my last one before we get started is check out the vibes. You know, I did originally name this topic customer service, but I think it's more than that. It's really truly the vibes. I know that's so dumb, but like when you're talking to this lender or the teamed lender, is this a good lender? Do you feel like they have your back? Do you feel like they're not just giving you like you call in, hey, I want an FHA loan, and they just give you an FHA loan? Or is this lender like, you know what, here's FHA, here's conventional. If you save up a little more down payment, we can get you this rate. If you want to go down payment assistance, this is what we can do. Just truly trying to protect you. And not only that, but they find out your whole, like what your home goals are and work around that rather than just giving you, here's FHA loan, have a good day. So fill out the vibes. If this is a good person, are these good people? Are they going to answer your phone call on the weekend? Are they going to close on time? All these quick critical questions are things you need to be asking. But anyways, I'm not here to tell you what loan to pick. I'm here to show you how to pick it. We're going to start out with the fresh page. First thing first, amortization schedule. I don't know how to spell. Amortization Calculator, okay? You're gonna notice some of these links are purple because I actually, went through them and tried to figure out the best ones. What I do is I open up, it's amortization-calc.com and bankrate.com/calculator/mortgage, whatever. So I get these two tabs, okay? This one is really, it looks really nice when you pull it up, and we'll see it right now. This one is very ugly, but it has a very functional tool that I like using. I'm gonna make up a loan scenario at the top of my head, okay? So kind of just so that way as we can kind of figure out what the best deal of both of them are. The first loan you're being quoted is a $300,000 purchase price. They're requiring you to put 10% down or $30,000 down. So that makes our loan amount $270,000. For that one, they're giving you a 3.2% interest rate. And that's all information we know. Second one is a $300,000 loan as well, but they're only requiring you to put 5% down, so that's gonna be $15,000 down. So that means our loan amount's only $285,000, and the interest rate is gonna be 4%. We're gonna start off, loan amount for the first one is gonna be $270,000. It's a 30-year loan, not 300 years, 30-year, and the interest rate's gonna be 3.2. We're gonna calculate it. Now we're gonna do the same thing on this one. We're not looking at your actual monthly payment. We're only focusing on the principal and interest. Remember, your monthly payment has 5 factors: principal, interest, taxes, home insurance, and your premium or your PMI or your mortgage insurance if you have it. We're not focusing on these things because we don't have the house yet, so we don't know what the taxes or the insurance or the PM. We might know what the PMI is, but all we're gonna focus on is the principal and interest. So if that number's already too high, you're in trouble because that's just your principal and interest. That's not adding anything else. So hopefully this number is like kind of good because they haven't added any of the other stuff yet. So when shopping these around, we're looking at just mortgage and interest because everything else depends on the house, depends on the circumstances of the taxes, insurance, all that stuff. So the first number I look at is going to be right here. $150,000 total interest paid over 30 years. If you live in this house for 30 years, you're gonna pay $150,000 worth of just pure interest rate. Now, the next thing I ask myself is, how long do I see myself living in this house? So if you're planning on living in this house for, let's say, a 5-year or 10-year, let's say in this point it's a 10-year house, what I like to do is I go 10 years forward. So I go to July. Now this is where I go to bank rate because bank rate, if you go here, I think it's show amortization schedule. Bank rate is very ugly. It's just all these numbers, and they're like on this website, they're nice and bold, like they change color of the year. Here it's a little more difficult, but what I like about bank rate is you can figure out how much interest you've paid up to this point. So using both of these calculators, I'm realizing that if I'm only gonna be here 10 years, I mean, I'm not here for 30 years, so that 150,000 numbers look scary, but I'm not gonna be there the whole term, but I am gonna be here for 10 years at least. And after 10 years, I'm gonna pay $76,000 of pure interest. And the second thing you wanna focus on, well, I put July 2031, my bad. It's July 2030, right here. The second thing you wanna look at is your principal, like what's gonna be your balance left over after 10 years. So in this case, my balance is gonna be $206,000 $173. So after 10 years, if realistically, if all the plans go well, I'm going to pay $76,000 of interest, and about $206,000 I'm going to have left on as the balance of the loan. So if it's worth, like, I don't know, $400 by then or $350 by then, I'm being very very generous, then I know what I have an idea about making. The monthly payment with just principal and interest. We know the total interest paid, and we know how much it's going to be realistically after 10 years. Basically, what's really cool about this amortization schedule, guys, usually it's used, people avoid it, they're scared of it, but I kind of like it because you can really get a good idea of where you're applying to here. So one thing I also consider here is I'm looking at how much the ratio of interest to principal is here. So the way your monthly payment works is it's always going to add up to the same number. So in this case, it's $720 of interest and $448 of principal. The way they figure out your interest payment of what you're going to apply that month is they're going to get your loan balance. So in this case, you start off your loan balance with $270. They multiply it with your interest rate, and whatever that number is, they divide it by 12. Do the math, it'll be about $720. So then what happens is they also apply your principal, and this number will always be the same. In this case, it is $1,168, so it's going to be this monthly payment. It will always add up to this monthly payment regardless of what time of the loan amount is. Even if you're at literally the last month paying the mortgage, it's always going to add up to that same number. So what I like figuring out with the interest rate I'm being quoted is how much am I applying ratio-wise. Now, it's always going to be more interest, so it's depressing. That's how mortgages work. I know, I'm sorry. But I like to kind of apply what the ratio is. So in this case, it's $720 divided by 1168. It's about 60%, 61, 62%. So it's 62% to 38%, 62% interest, 38% principal. So we're starting off paying almost 40% towards the principal of our payment. Okay, you guys got all that information down now. Now let's shop around the next one. The next one was going to be $285, 30-year loan at 4%. Now we're going to come back to our bank rate. Now let's do the same thing we did for the other one. Total interest paid. We only added 0.8%. Just with that 0.8% and the extra 15K, total interest paid is $204,828. About $54,000 difference. Remember, you're only going to live in this house for 10 years. So we're going to go to July 2030. We're going to also find it on this one. So in July 2030, our balance is going to be $224,000, and our total interest paid $102,810. So almost 100K. Hopefully you guys are writing it down like I am, so you can kind of see them compared apples to apples. And then now what we're going to do is we're going to figure out our ratios. So it's going to always add up to this number, 1360. So what I'm going to do is I'm going to get 950 divided by 1360 to get an idea of my ratio. So it's 70%, 69.8, so 70. So basically I'm starting off paying 70% of my payment towards the interest and 30% of my principal. So at about a 10% difference, right? So now let's compare these rates. So one is clearly going to save you $15,000. Option B is going to charge you over 30 years. It's going to be an extra $54,000 of interest. But you're not being there 30 years, so let's look at the 10-year mark. After 10 years, it's going to be a difference about, what is that, $26,000, $24,000 to $26,000 difference of pure interest. Your balance is actually going to be about $18,000 to $20,000 more, and you're starting off paying more towards your interest than your principal. So even though you're saving $15,000 of a down payment, you're paying approximately an extra $25,900 of pure interest. That $15,000 means a lot to different people, and it doesn't mean that much to other people. Maybe you have $50,000 saved, an extra 15K won't kill you. Maybe you barely have the 5% saved up, and you literally cannot come up with an extra 15,000. It's just insane. So you have to figure out which is really the best situation for you. Now, everybody would love to put the higher down and get the better interest rate, but the question is, can you? If you're not able to, then this second scenario is just fine to make it work what you need to work. Once again, putting our big boy and big girl pants on, we're looking at more than just the monthly payment. We're looking at what is is our money working better for us in one scenario than the other? Buying a house isn't just like, okay, I bought a house, my life is complete. It's an asset, it's a financial asset. It's like you're gonna invest in a stock. Are you gonna invest in a company that's gonna produce more money for you, or are you gonna invest in a company that's gonna lose more money for you? So it's really important we take care of our finances now, that way we put ourselves in a better position when it comes time to buy. And that's all the time we have for today, guys. Thank you so much for watching. I really appreciate your time. If you guys have any questions, please leave them in the comments below. Myself and the Home Goal Homies will happily help and answer any questions you guys might have. If this is the first time you're watching a video, hey, consider liking and subscribing. We make 2 to 3 real estate weekly videos a day. It's been a long day. We make at least 2 to 3 real estate videos every week to help you accomplish your home goals. If you are in the Phoenix, Arizona area and you're looking to hire a real estate agent, you can definitely reach out to me. My contact information can be found on my website, which the links are below. All of my social media there as well, in case you want to send me a casual question or comment to kind of help you with your home goals. And of course, you can also follow me on them. That would be amazing. And of course, the link to my Home Goal Helper, which is a digital interactive ebook that you can purchase and help you with your home goals. So other than that, guys, I look forward to seeing your questions. Thank you so much for your time. Have a wonderful day.